Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. Welcome to... Well, I don't know. I don't know what this is. Well, no, it's welcome to my stream. But hey, we've got a big transition week. Come in here. Really last week was kind of the last week of summer, but this is kind of the last week of summer. Not like the official like weather summer, but like trading summer. If I come over here, you see I'm not done switching actually. Let's just take a moment to switch everything, all right? We need to be ZBZ2. Okay, lots more liquidity over here. And this is a much more healthy liquidity level, more like I would expect to be seeing at the moment. So let's come over to the charts now. Oh, we got some auto rollovers in here. New expiry, Z. N. Yes. Okay. Interesting that we've been rallying a little bit here in the morning and the volume is still down. Okay, so anyways, in the 10-year, we had another pretty decent flush to the downside. Some hawkishness in Europe coming out here. And I think that there's probably a lot more of this to come. With, again, at Jackson Hole, Chairman Powell saying more pain to come. S&P 500 really not liking that last Friday. I mean, overnight, pretty contained range, but whoosh, that was like another 4% down day, something like that. Actually, let's come over here on the NQ. Oh, did it not save my freaking changes? I hate it when I do that. Because, like, I have a lovely little indicator that I can stick on here. I need to get this stuff out. I'm getting close. My multi-ITR, and we want to be percentages. There we go. It was almost a 5% day. Can you believe that? Actually, I have to change. Really the default. Maybe I need to change on this thing. The default should be on price change. No, on this one. Should be on price change. There we go. Then we can see where we're at already. We're already decent range for the overnight. All right. Oil. Well, oil actually a little bit higher. Again, oil continues to struggle, and there's a lot of concerns about global growth and that hitting the oil. But other people saying that the reports about oil demand are manipulated or wrong and not in line with fundamentals. The Saudi Arabians believe that and think that oil is going to go higher. We got gold and silver. Gold and silver hurting after this, increase in rate expectations. Copper also really getting pummeled this morning. Very, very interesting. And we come over to the currencies. We are seeing, well, we did see quite a decline in Bitcoin on Friday after the Jackson Hole comments, and they are now down below 2,000. Once again, that could lead to some pain. I think that we're going to need like a new lows before you start seeing like real like shorts piling on sort of a thing, but it does not look very good in Bitcoin again. And then we've got the dollar 109. So the dollar strength continues. And something that we're seeing is that even though the ECB is being quite hawkish and everything, it is not rolling through into euro strength versus the dollar. Well, I mean, maybe it is a little bit, but I mean, come on. Dollar's 108.54. That's pretty, yeah. Okay, so let's come over here. Let's make sure. Oh, we don't quite have all of our instruments switched over. So this should be ZBZ. Come on. Move this out of the way for a bit. ZFZ. Okay. Okay. And I think that's everything. I'll move this over here. All right. I feel like I'm missing something, but I don't know. So what do you think? I got this flag. I think it needs to go underneath. I think it needs to go underneath of the stop, but I don't think. Nah, I'm gonna have to find something to hang it underneath of it. If I want it to be underneath of the light sign. It's okay. You can still see it for now. Let's see here. I do have 2 bites of oatmeal left here, so let's take care of that. Treasury's still kind of showing some pressure to the upside in a large order at just beyond price at 08. All right. Well, let's look and see what's going on Twitter. Taleb. Well, that's nothing too interesting to us, but Taleb has been yapping a lot the past 24 hours. Momentum chasers trade everything these days. Electricity as well. What goes up must come down, perhaps, says the market year. Wow, that is a really parabolic looking chart. The treasuries here. I mean, I think that somebody wants it to go at 08, but the correlations perhaps not cooperating. 6J is very much up, though. 6J is very much up, so. There you go, Nassim Taleb. The costs of the debt jubilee should be borne by universities, not taxpayers, thus Nassim Taleb says on student loans. You know what? I was watching this thing the other day, noting a couple of interesting things about the debt payments, and he was talking about how, the debt payments are capped at 5% of your discretionary income, and instead of 10% as it was before. And what they define as your discretionary income is much more generous than it was before. And when he walked through it, I think he really made a good case that the changes that Biden has made to this debt program essentially encourages students to take on as much debt as possible. Because you're going to come in, you're only going to be able to pay, or you're only going to have to pay 5% of your debt. And then, depending on how much you took out, it goes away after 20 years, no matter what. So why wouldn't you take on as much debt as possible and go to the nicest school as possible? I think that there's going to be some real, like the thing that scares me about a policy like that is that there's very significant costs to a plan like that. Large offer there at 05 half following that down, but it quickly disappeared. Pushing the bottom of this. 3.1, man, that is a little bit. Well, the S&P 500 is on the upturn at the moment. 6J is turning back down. I'm not confident enough to say that that's a reversal. It could be. 3.1 may turn out to be a great place to get in. It seems like an okay spot. But it could just be falling back into a liquidity hole somewhere around well, okay, we're already there at 03 half, so let's just kind of sit here and wait and see if what the liquidity looks like down here. That 05 half, that tick on the way down, that was pretty significant. Although one does have to wonder if we tick back up, if those pull, if it's a spoof. I don't know about that one. Anyways, the student debt. The thing that concerns me about student debt the most is that there are significant costs associated with these changes, and it's very difficult for us to be able to analyze all of the differences that it's going to make and the changes that it's going to have on future behavior. But you're probably not going to see those differences right away, right? It could be another 5, 6, 10 years before this like really pulls through and people are like, oh, this was like a really, really bad idea, right? I'm seeing that with a lot of government policies these days. It's like the politicians know that what they're doing is going to have a long-term negative impact, but they also know that the voters won't realize it until after the election or whatever it is, and so they do it. Well, let's see what they do in the 10-year here. Was 05. Note there, I mean, I think 05 would be a key spot. They're not going for it yet. S&P 500 does look positive, though. Oh, let's make sure I didn't check to make sure that I have my news feed on. And we don't have a whole lot of news today, by the way. We're just lining the pockets of the banksters. Well, apparently, I mean, the people that benefit from that policy, I mean, they do kind of. I don't think that it's the traditional banks, right? So really, academia is the one that benefits the most, right? Like there are plenty of academic programs out there that don't really have very much real world application. Okay, so they did take O5, kind of took a little bit to coax them into it. They ticked up the large order at O5 half, completely disappeared. But yeah, there's all of these programs that really aren't worth what they're charging for them and really don't have any real world application. And the people that are taking those programs are being saddled with excessive debt and absolutely no way to pay it because they go and they get their humanities degrees in whatever humanities that it is. And then they become a barista and no way you're going to pay that back. And that's who really gets bailed out here because now these people have students have the incentive to take on any whatever kind of debt is required in order for them to pursue whatever degree that they would like. And yeah, I mean, the thing that irks me about it is that I was an engineer. I did computer science. Computer science was hard. I see a lot of people trying to say, oh, well, you don't really need to go to a university to learn how to code. You don't, and you can get a good job from going to a coding camp and stuff. Don't get me wrong. But it is not the same thing as going to university. That was freaking hard. They were thorough. They tested us, man. And we need more people to do that. And we should be setting the system up to encourage people to become engineers because every person we have out there that has the capacity to be an engineer, we probably need to be an engineer. You know?
Commentary from Germany's Chancellor,
So
who says that I am confident on the EU agreement on
I don't
addressing
like
power
this whole
crisis.
well, we're just gonna pay all the debts and then you can go and be in anything you want. I don't know. When I think about my kids, because I'm concerned that my kids are going to have to take on a lot of student debt. But I guess if they only have to pay 5% of their discretionary income, that's not actually that much. It's not actually that much. And then you just discharge it after 20 years, right? Ooh, 6 maybe. Well, I have to say, they dropped down, I said, well, they may be falling back down into the liquidity hole at 03 half, but nothing really traded at 03 half, and we are popping right back up. So I don't think that I can see that as being driven by liquidity, but rather that we do have a market that is just able to turn on a dime very quickly. It's now giving us, wow, 3095. And what I'm seeing here is like kind of a bit of an ascending triangle sort of a setup, or which is to say that they want to get above '06, but they're having trouble doing it, and each time they fall back down, it's just a little bit less. But when they get to '06, it's not like there's a ton of orders trying to push through it or anything like that. It's just kind of trickling in. So, in other words, I'm not really getting very strong market order flows here at the moment. So we could see, I think that when we're on the beginning of the week on a Monday after a week like we had, there could be some people out there lurking ready to make big moves. But that's not what the flow suggests is happening right now. It's fairly quiet, although it is moving around a lot. I think that a lot of this action is being driven by the currencies at the moment. And yeah. Just make sure I got everything right here. I feel like I got something set up wrong, but we got everything. There's 12, 12, 12, 12. ES is still on 9. No, I think we're good. Now let's come back over here on the market. Oh, wow. So copper is the biggest loser today. Oh, you know what? Let's get rid of this column. I have this AMA relative volume column, which I think is really cool. And is very good at telling you like what is happening the fastest. But to put it on every instrument is just too much. So I'm going to take it off there. And save my workspace. I'm just noticing that there and remembering that that seemed to be the thing that really would slow the machine down. And by the way, when we saw the things kind of flip back down, we also saw a trend start in the in oil. Now I don't see anything. Let's see here. What's this Citigroup? Whether the Fed hikes 50 or 75 basis points on September 21st will depend on the details of the September 13th CPI inflation report. Used car prices will likely weigh on the core reading, but strong advances in shelter and other services keep us expecting a 75 basis point increase. Interesting. Well, and it's still kind of dancing there at 05.5. So maybe we've just formed the liquidity hole there. Again, I mean, 09.5 ain't bad. Don't get me wrong, 09.5 ain't bad. Ain't a bad price at all.
The EU is working
But
on structural
I'm not
reform
getting
of the
like a
power
readings that
market.
there's a
It's
huge
preparing
flow
the
out
power
there per
markets for
se.
emergency intervention. That's EU Commission President von der Leyen currently.
And the
speaking at
timing
the
is wrong. But I do, so this is kind of a weird, I think this might be a unique situation where maybe we could justify taking it at 09.5, even though I don't think that the timing is very right and everything. Oh no, NASA scrubs launch of its new moon rocket on a no crew test flight because of fuel leaks. That's no good. I'll have to try picking that guy off there because I am starting to see a little bit of pressure forming, and I don't know why there'd, be one lot there. Should have just taken the 5 when it was there, huh? EU preparing power market emergency intervention, says von der Leyen. You're waiting for that launch on the back patio. Oh, wow, you're that close, huh? We watch SpaceX rockets go up like balloons all the time. I forgot, though. It's NASA, which means government, which means the launch will be scrubbed. Well, they did scrub it. Well, there you go. There's 09.5 now if you want it. I'm kind of tempted to hit that too, but no. I mean, I think I can justify one contract here, but not two. Need to see strong flow to take two. Kind of looks like there was a little bit of pressure there pushing him down, and then they fell back into the hole. No, Ninja Trader 8 told me to roll over. I rolled everything over. I'm on December for my main contracts. Sean Hannity tweets, even Dems claim Biden's student debt forgiveness out of touch with what American people want. Now, normally I wouldn't think that you guys would care what Sean Hannity thinks, but there's a very interesting political argument going on here because a lot of Democrats think that the student debt forgiveness will really help Biden in the election. By the way, here's a story. I think this is an important thing to note, okay, on the political side. Janet Yellen and Joe Biden's economic advisors advised him against making the call for student debt forgiveness. And it was very much like a made on the fly sort of last second sort of, thing where they were arguing back and forth up until it happened, which is why the White House didn't really have a whole lot of a plan or anything like that to implement it. And who was it that was pushing him to do it? Who was the person that he listened to that made the difference? Well, it was the vice president. It was Kamala Harris. So Joe Biden is listening to Kamala Harris right now. And I think that he has probably been listening to her for a while, and that the last couple of slew of what we would call wins for the White House maybe because of her. And I think that that is a key point that may matter to some of his policy decisions going forward. Weird, your data is missing the 14 contracts traded at 03. Well, when did you see that they had traded? Did they trade before? I mean, if you're saying that even if you reset at the regular session open, that you had some that traded at 03? If so, that is weird. Because we're not in a position where I would have thought that we would have lost some. Yeah, okay. So same as me. That's weird. Can't explain that. Really can't. I've been diving into data really deep lately, and there's some really interesting nuances with data, man. Because there's this whole thing that a change in the level 2 should happen before you see the volume. Like in an ideal world, you'll see the level 2 decrease and then you'll see the order. But I don't think that that's the way that any of our data does it. It's kind of weird. Because what you want to be able to do, another thing that would be beneficial or is kind of like optimal, let's say, for being able to like sort out what happened algorithmically, is that for every order, every individual market order, there's a change in the level 2 in the market depth.
Time now at the top of the hour. We are expecting to hear comments from ECB's Lane. Also expecting comments.
So if like 2 orders came in and each took 100 contracts each, it's better that you see the level 2 change twice rather than that get aggregated together. But I'm pretty sure that all of our data would potentially aggregate those together, especially if they're really close.
Participating in a policy panel at the 2022 annual meeting of the Central Bank Research Association, or CBRA. No indication of a text or Q&A for Lane, however.
So they were kind of pressuring them to the upside, and it didn't really move a whole lot. Now they're pressuring to the downside. I think we're kind of getting a little bit of a push and pull here where the market makers want it to get out of this range because not a whole lot is happening in this range, but there's not a ton of orders slipping through either way. The amount that cumulative delta is changing here in this area, it's only by like a few hundred. It's very tight. Unless you're set to 839, I don't think that's the case. But I mean, we can remember when we were down there at 03.5, we only saw the 64 trade at 03.5. How much do you have at 03.5? Do you see 64 at 03.5 as well? Because if you have 64 at 03.5 and then you have some at 03, then I'm really weird. Like that really, really weirds me out, right? that eliminates a good number of the possibilities. 64, 131. Yeah, I don't know. And you're on December. Well, I'm seeing corn take off here. That's interesting. All of a sudden, corn is the biggest winner here today, followed by oil, and then the 60. Everything else is down. Oh, that's weird, man. Difference between CQG and rhythmic data? Really shouldn't be. I mean, it's a teeny tiny little difference, but that's more than it should be, for sure. Oh man, there was lots of people down in Florida waiting to see the rocket launched and everything too. I mean, I guess if I had the opportunity to go see it, I would want to go see it because that's like the biggest rocket ever, right? Well, not ever, but on par with one of the biggest rockets ever. That would be quite a launch to watch. So S&P 500 kind of going sideways, by the way. Seems like there was a big spike up shortly after things got going here, but now they're kind of going sideways, maybe even being pressured to the downside. Point of control / view ups are the same, but like every other price is slightly different. That's a little weird. And you're on ZNZ2. Let's see here. Brannigan Barrett tweeting a little storm here. A thought about markets. Prior to Jackson Hole, markets staged a significant rally on the idea of a Fed pivot. A pivot is simply moving from a hiking to cutting cycle without a pause at peak rates. The logic was that equity valuations could withstand a short-term higher rate environment. Powell then came out and signaled rates would remain at the peak level around 3.75 for some time. The word was intentionally used because it pushes back the idea of pivot similar to 2018, but keeps options open to beginning cutting should economic data turn sour fast. Here is another thing to think about. Heading into Jackson Hole, market was pricing some cuts around the June month. All that has happened since then is the market now thinks cuts can come in September, instead providing Mr. Powell with some time. Was the meeting really that hawkish? My view is simple. The Fed officials were pushing back against the idea of cuts in 2023 well before Powell spoke, and markets didn't react. The overreaction on Friday is more of a case of poor liquidity than a fundamental shift. What this means is moving forward as traders, we back to watching the data, CPI and non-farms payroll. What will determine the next 5% will boil down to what the front end yields do as a result of this data. Trading from now, the only thing we can be certain of is volatility in the near term here to stay as summer is over and the fun and games begin. He's totally right on that point. I think it was a little bit more than just liquidity. I think that a lot of people were caught off guard from that news because there's some people in the equity markets that have just not been listening to the Federal Reserve. But he is very right in that the next set of data is going to be very decisive here. Although I personally, after reading that Citigroup analysis, does kind of have me leaning towards a 75 basis point hike. And here in the Fed member, another thing is that we keep having these Fed members say, we probably need to
we have provided
probably need to get to 4%
for the CBRA annual meeting for 2022, again with ECB's Lane, as well as Rick's Bank's Deputy Governor Floden. That link is available on the feed if you'd like to watch along.
Oop, there's some spam in Discord. Ban. Okay, so 5-year, a little bit more the driver here this morning. 30-year holding back. He printed some into 07. Well, I'll tell you what, on the small little scalps here lately, I haven't been catching much luck. How they come all the way back down again, 3 ticks down just like that. I don't know, guys. It could just be poor liquidity here. That just seems to move way too easily when it actually does. ZB in particular fell there. I guess they didn't come through the bottom or anything, and the ZB should be, given the spread, I think we would see the ZB doing that, but could the ZB drag them down? Possible. I would still, the bear steepener, you know, I'm still kind of waiting for a really, really strong bear steepener day. I think that it could happen here eventually.
So we should shortly be expecting comments from both ECB's Lane and Riksbank's Deputy Governor Floden. Again, if you'd like to watch live, the link is available on the feed.
Let's recenter things.
Effective Fed funds rates 2.33% for August 26th versus 2.33% August 25th.
Good morning, D. How are you? Well, the rally in oil appears to be fizzling out. Corn is still moving strongly here. Gold is moving strongly here. Currency's not quite so much. Dollar maybe hinting that it could do something, but we might get some news coming out of Sebra. I don't know what that is, but apparently ECB's Lane and Riksbank's Deputy Governor Floden will be speaking. Could potentially bring some news out. Well, I'm sure that Lane will probably say something hawkish like all of the ECB governors have been saying, huh? Part of me wonders if there's somebody just at 08 really, really, really wants their fills, you know? That move was hurt a little bit. But like I said, the volume here, actually, the only place that I'm actually seeing buying, and it's kind of only tepid, is in the 10-year. The other two are actually kind of more net selling in the end. And I'm not seeing a drive higher in the 6J. So I kind of think I have a lot of reason to be skeptical of this move, but again, like there's that liquidity at 08. And not much motion on the chart, says Mr. Brownie. It's just kind of like it's a little suspect, right?
We are seeing comments come through from ECB's lane now saying that the ECB must provide assurance that it will meet its
Well,
mandate.
At least one order went into 08, and then they fall back down again.
ECB's lane says inflation is expected to remain high in the near term.
Okay, Lane is speaking. Says inflation is expected to remain high in the near term.
More comments from French PM Born says the country must organise lowering its gas consumption, otherwise there will be risk to supply.
Falling right back down into the hole again at 06?
ECB's lane
05, it's really more 05 half,
will be
06.
subject to push-pull dynamics. Lane adding that September is to mark the start of a new policy phase.
September to mark the start of a new policy phase. I didn't really think of it that way. Like I definitely was catching on that the ECB was like getting more hawkish and that they wanted to be more forceful in September.
ECB's lane says
But I didn't think of it as a new policy phase. I don't know if that's important or not, but
reasons.
ouch. Strong downtick there.
News phase based on meeting by meeting approach. So that's ECB's lane there saying that September is to mark a new phase of a policy, the new phase based on a meeting by meeting approach.
Well, the order at 04 ain't as big as the one at 08, but let's see if we get down to the bottom there and they trade through that.
Long-term
at the moment, they're not going for it.
Close to 2%.
At the moment, they're not going for it. Maybe ECB's lane causing the bearishness in the treasury here. The 30-year did break out of the bottom of its range. The 5-year fighting it. Definitely a steepener today.
French PM Born as well says that all companies must in September draw up an emergency sobriety plan. That's French PM Born saying that all companies must in September draw up an energy sobriety plan. Adding that if it comes to energy rationing, companies will be hit first.
So there was this celebrity accepting an award at an award show yesterday. I forget which one. And they said that they were oppressed in that award receiving. So the guys on the right on Twitter
energy savings plan
are like hyper focused on that today, which I think is kind of silly. I'm kind of like, who cares?
More comments from
Who cares?
Lane, who says the evolution of the terminal rate is too.
But it is interesting that that's what they choose to focus on today. That's where all of their meme energy is. Seems like a waste. Okay, there's a down tick at 05 half. Yeah, man, the 05 just doesn't look too strong, but I think it will probably take more than that to coax them to take it off her. Okay. So a little bit more that time, 570. So we are seeing that there is a liquidity hole at 05 half 06 or so, and that it's a little bit difficult to get through here. I think that there was more attempts to break out through the upside. So it could be the case that if we break down, that there could be a lot more flow to follow it. But again, right now we're not seeing the market orders come through. And there does appear to be a little bit more liquidity at 04 half and 04, at least latent liquidity. We're maybe just a tad early, but if we were going to see like a large meta order sell, now would be a decent time to see it start coming through. I think you're already kind of like the volume in the 5-year is like quite a bit more consistently down, even though it's been fighting it. It's a little bit more consistently down in the 5-year. So that's the spread we got going on there. Okay. And back into the hole. It's actually spreading even more there. Okay, now that one, the 5-year pushed up very aggressively, and the 10-year followed it.
ECB's lane says a steady pace of hikes to the terminal rate is important.
ECB's lane still speaking. Although I didn't think there was anything too significant about what he just said there, so I don't know if that's what was driving it or what, but he might be getting push and pull here. Like that might be pull the 5-year up so that you can get a fill at 08. Because it really did not take very much volume to shove the 5-year all the way up to the high. I also would say that the hole here seems to extend through this higher end now. Maybe because they've traded through that quite a bit. But you still got that big order at 08 for them to make it through. I want to think that there's something significant about the order at 08, but, probably there's not, given that it's the high of the session and everything. I mean, it didn't start out as the high of the session, but if they trade into it, that there probably could be a little bit of a stop run, but that doesn't necessarily mean that it's going to turn into a trend. Oh, Jim Iorio says that he's being accused of being political. You are being political, Jim. Markets and politics are intrinsically linked. Sorry. See, so that time, the 10-year ticked down a little bit. And again, it's kind of like somebody really wants it to trade 08. Like I detect maybe a little bit of tape painting. S&P 500 turning down a little bit there on that last candle. Spot Gamma, there was a huge surge in large trader put buying in the equity space last week as per the OCC data. This was not the case in the retail small lot trading. I do wonder if now is a good time to go buy some puts to hedge our equity portfolio. Everything that I see out there just feels negative, on the economy at large, especially with everything that's going on in Europe. And it fell back down again. Though it does still kind of feel like an ascending triangle sort of setup to me.
Hikes are less likely to bring adverse effects.
Huh. ECB's Lane saying something, smaller hikes less likely to bring adverse effects. I'm wondering what the context of him saying that was. A little too easy for it to trade 06 half. Probably that's the case all the way down to 05 half again, if they choose to go that way. Let's see, some of these upticks at 07 were like on
ECB's Lane
barely a dozen
smaller hikes
contracts.
also make it easier to correct course.
Definitely the 5-year dragging them out. So I'm going to reset my DOM here, kind of get them a little bit more in line. Since I did see a flattening back out in the curve. Okay. Downtick out of the range. And as I suspected, 06 and 05 half still, well, I mean, we haven't seen what it trades at 05 half, but 06 is still a little mushy. You know what we need? We need to, what is the Rumble spec? It was like FC or something like that. FCVI.
ECB's Lane says the economic cycle is to play a key role in wage and the price path. That's ECB's Lane there, saying the economic cycle is to play a key role in the wage and price path.
No symbols match your criteria. Does not show up on my trading view. But I suspect that that could have a big run today, since we're getting close to the open. FC acquisition CF. Oh, CFVI, not FC. CFVI. There we go. Oh, well, it is up in the overnight. It's actually not that much. It's only up maybe 0.4%. You like the news, Adam? What are you talking about? This seems like a good trade. I think that 0.4 is too little, although I'm a little concerned about the broader market for a trade like that. There's definitely going to be people waiting to buy that on the open, though. Oh, you can hear this quack. Oh, gosh. Sorry, you don't get that anymore. Not supposed to hear that. You have to go and buy the Financial Juice subscription. Yeah, next time that happens, don't say anything. Hmm. 06F trading back and forth a little bit. I gotcha. What do you guys think about the FCVI thing? So let me back out and be a little bit more thorough. So Andrew Tate got banned everywhere, and so he has moved to the platform Rumble. Rumble has an agreement with a special acquisition corporation, ticker symbol CFVI. That's been going on for quite some time. I saw a lot of people on TikTok talking about the stock ticker. So CFVI is already up in the overnight. We're at 10.4. I'm still surprised the CME doesn't do that for dump streamers. Well, for starters, they probably don't know, to be honest with you. To be honest, I don't think they ever look at that sort of a thing. But I really wouldn't expect them to care. Because, you're getting the data delayed by several seconds. So it's not the same as paying for it yourself, right? I mean, if you're going to trade, you're going to pay for it yourself. If I was the CME, I would be encouraging it because it would lead to more people wanting to buy that data, right? Yeah, you do get the squawk delayed, but I don't know if the delay on the squawk is enough. How much is it delayed? So they have like a free version of Financial Juice, but I don't know how much delayed that is. I think that delay is more like 15 seconds, and my delay is more like 5. Which is why, like, if you send a message, it's about 10 seconds before I can see and respond to it. Well, man, again, they fell into the hole, but then when things kind of like settle back out, they're still like up there at that high, like that big order at 08 really wants to fill. Yeah. I mean, if they come in and they say you can't show your DOM anymore, then the stream could just be my face, I guess. That's what we'd have to do, right? My face in a chart. Okay, that's a much stronger bid at 07.5, and there's even a little bit of ramping. Not a whole lot of volume hitting into 08 though. They're really having to force it. And I think we're well past the time where I would have expected to see like a a strong meta order come in. Tickling it's not so. Yeah. This just kind of looks to me like your typical market making. The 5, so the 10-year seems to be lagging quite a bit today, doesn't it? Uzi says I yet to see anything big over 500 on the tape. Yeah, same here. 1,000 to trade it down. $950 on the other side. I guess they're a little bit more interested in trading it at 07.5. That right there looks like luring to me. Like the level 2 kind of pulled a little bit and a bunch of robots come in to take it and the icebergs down ticks. Yep. Just a small thing. At least it's some life, yeah. But I think it's that somebody's selling it at 07.5. That doesn't mean that they're not going to trade through the 08. It just means we kind of have to be a little bit worried about reading too much into what it's doing at the moment. Because everything's going to seem significant, right? When the activity is so poor, right? Here's an uptick. Not as strong of a bid, but okay, where was it? What was that click? That was ask at 19. Interesting. Oh, that's way further. It was a 118.19, so large order way, way, way far away. But that's one that we haven't seen recently. So that just means that there's a robot that an old friend is back. That tick not holding. Yeah, I don't think that I have a filter on how far away it will look. I have some seeing positions as far as yeah, there's no limit. So the furthest one I see out was 160 ticks away. Is there anything abnormally large? Not really. So I can only see here what's on my DOM. The next big one is at 16, which is an even number. So I think that what that suggests to me is that the market making robots are back from the summer already. Because basically they're putting their liquidity like way out there beyond where anybody else would have anything, just so that they have the spot reserved. I'm still annoyed that CQG/kinetic only gives you 10 levels. Yeah, in the treasuries, I feel like it should be more than 10. It should be at least like a multiple of 4. It should be like 16. Give them 16 levels. CQG. Or 32 levels. Give them 32 levels. Well, the amount of volume at 08 is no longer unusual, but they're still being skittish about trading it. I don't think that Rhythmic's price is significantly less than Kinetic. Okay. There was a little bit of a forceful push there on to the downside. 2 ticks. Oh, I think that in the end, it all comes out to be like $50 a month. Like the CME fee alone is like 30, right? And then everything else I think ends up being 10 to 20. You pay 121. What? You're doing something extra to get for it to be 121. Some extra exchange or index or something that you're getting. No follow through on that yet, but that was 2 ticks down was a little interesting. See a little bit of a downtick there, but they had trouble holding it. So the other two aren't cooperating. It goes down, but ZB doesn't. Iceberg. Iceberg at 07? No, I get the CME bundle. But the CME bundle is, the exchange fee is only like $30. Unless something changed and I'm getting charged a lot more than that, I didn't realize it because I'm not looking at the statements. Okay, so they did attempt to push it back up 07.5, but this time in the 5-year, there's an iceberg at 31 3/4. Oh, well, maybe it's because you're using kinetic. Yeah, that's right. Kinetic 121, maybe. If you were using continuum, then it would not be. There's definitely an iceberg there in the 5-year at 31 3/4. So there might be an iceberg at 31.5 too. Okay, they traded through it. Down tick again. That one was held a little bit better. Oh, an 06.5. That was a good down tick too. Let's set it here. S&P 500. Initial move here on the open so far is a buy. Even though the cumulative delta is very much on the sell side in ES. And FCVI opening about where it was at 10.4. Well, that's not as much open drama as I was hoping for, so maybe that one's not worth looking at. I guess the top G is not enough on its own for a solid trade. CNN Politics tweets about Elizabeth Warren. She said this yesterday, but Elizabeth Warren slams Federal Reserve Chairman Jerome Powell over interest rate comments. I'm very worried that the Fed is going to tip this economy into a recession. Well, I mean, if the Federal Reserve is following its policy objective that is prescribed by the government, then it's not the Federal Reserve's fault. It's the fault of the policymakers that created the economic environment that forced the Federal Reserve to raise rates. Liz. There's some good excursion on the downside. They are pulling back a little bit now, though. And I'm noticing a change in the spread. So it's a lot flatter now. So we are getting a little bit of flattening in the curve, but then I'm also seeing that the three of these are moving much more in tandem. No big change in the 6J as of yet, but hinting that it might want to be coming down. And gold have not moved here, but gold has had a good run here this morning. Oh, and looks like oil is taking another push higher here. So this push down in the treasuries may be driven by oil. The S&P 500's still going there. I'm actually surprised. So they're beating out the last overnight pivot at the moment. Just barely kissing it. And the treasuries down to the lower end of the range. Not trading 04 yet, though. You think it's crappy rollover movement? Oh, yeah. Dude, Mark, I just totally forgot. We should have the music. Why don't we have music? I felt like something was off. I feel so silly. You know what I don't like? I don't like applications that are actually a web browser. Like it's not actually an application, it's actually a web browser. Because web browsers use a lot of memory and resources. Well, there's an uptick. So I'm thinking that last move down was a little impulsive, so it looks like it still flows a little bit weak. We did get on that move down, that was looked much more like a meta order. So either gonna have to bust through 04 if we're ever gonna go anywhere. Are we gonna spend this whole session inside of this like 8 tick range? That would be awfully annoying. And like here's the thing, like I wouldn't discount the possibility of them touching 08 again, and heck, maybe even busting through 08 and having like a furious stop run, but then coming back down into the range, you know. I thought that there would be reason for them to be making a move here and have rates increase after the craziness that happened on Friday. But what it seems like so far is that the market just, since they're not too sure what the next slate of data is going to be, they're just kind of sitting on it. Do you think that there was some selling through that? This move here, it is oil. It is definitely oil. So oil took a big spike up there, and it's coming back pretty forcefully. Like oil spiked $1, and now it has come back almost $1. And the treasury seems to be reflecting that. Oil is now the biggest winner today at 2.28%. At which time does the indexes start to range a lot with little to no trend line? What do you mean by that? That's all the time. These days, it seems like. It seems to me that at about 9:15 Eastern time, a lot of moves kind of get started. And 10:30 Eastern time. So really from 10:15 to 10:45 Eastern time is also a period where we tend to have a lot of mean reversion and or reversals. So maybe you're talking about that. Maybe you're talking about that 8:30 reversal time. It's 8:30 my time, 10:30 Eastern time. S&P 500 still looking good. So what is this from 4043 is previous days what now? Oh, I can't see. I have to come and look on the volume profile. Previous day's close. Ah, so this move here in the S&P 500 is just a gap fill so far. Whoa, what? Would you pay an additional $2,000 in income taxes per year to fund Biden's $10K college student loan forgiveness program? Yes, that's the actual cost for every taxpayer on average. Not per year. It's not per year, is it? No, it's my money. 91.1%. No, it's my money. 247 votes. Well, I mean, that's not a very fair survey, Zero Hedge. Or GovTrader. Still has this name as Zero Hedge. That's funny. I saw the other day that Zero Hedge got banned, but then I haven't seen anything else on it. Did they get unbanned? I did not follow through. Okay, no. 10:30 Eastern time in the morning. So in about an hour, you get a time period in the S&P 500 where, well, really all of the assets where there are a lot more reversals. Like if you look at like days where there's a reversal, a larger portion of them happen during that time period than any other time. How did you get out, doggo? Yeah. So it's just kind of like what happens is the S&P 500 will make its like initial push, and that first hour of trading has a lot of volume and everything, and then that kind of sputters out, right? And like, you know, that there's something like the high and low of the day are usually made in the first 30 minutes, right? And then 8:30 you kind of get the pushback, essentially is what causes that. Well, not a whole lot trading into 04, but it doesn't look nearly as, doesn't stand out as much as it did before, does it? Although there is a little bit of liquidity below us. If we're going to push through there, there's going to, you know, we really do have to have a large meta order pushing. So it's not a range. Well, I don't know what you want to. Think of it in like that for like a move to happen and then cool down, it takes about an hour. Oh, the last hour before the close is the best for range? Well, I don't know about that. I would be a little bit weary about a strategy as simple as go for a range trade at a certain time of day. Right? I would be looking more for a certain type of condition. So I feel that this sort of condition is not as reliable nor easy to see in the treasury as it is in the S&P 500 as it is the treasury, or rather you're more likely to find it in the treasury. But when you get these liquidity holes, those can range for quite some time in the treasury, right? Now the problem with the treasury is that when it does that one, it'll range in like a 3-tick range forever, and so you can't make any money on it, but because the range isn't wide enough. Except for when we've in this latest action where it's been like really, really illiquid. Here's another way of thinking about this, okay? Orders move markets. So when we have a large order coming in and pushing markets, that's when you're going to have the most movement, right? When you're going to get a range, the range basically means that that's not happening. So why would you want to play the ranges? You get what I mean? For the market maker, then the range is great, right? But the reason that the market maker is able to take advantage of that range is because they have multiple contracts. They have a big wad of cash to be able to trade and provide liquidity, and they're very fast, right? Like, the thing is I could come in and I could be fast and I could maybe catch the edge on like one tick, but like, could you catch the edge like every time that it ticks and change your orders and stuff every time? It's, man, I mean, I think that's what Navinder was doing before the robots came along and stole his lunch. But, you know, it's a very tedious way of trading, right? So I'm not very interested in it when it's ranging, unless I really have a strong reason to believe that it's gonna break in one direction or another eventually, because of some fundamental reason or predictor of order flow that we have, rather. So, but if I was looking for quote unquote mean, let's not say range, but mean reversion, if I was looking for mean reversion, I would be looking between 10:15 and 10:45 Eastern time. Just looking for a trading window when the market has a little probabilities to trend strongly in one direction. But why would it have, why do you think that it would be more likely to range during one time of the day as opposed to another time of the day? I mean, I guess avoid the open and close. That would help, because those are the times where the market is likely to trend, and that's just because that's when the most activity is happening. But like the ranging, as far as I can tell, is kind of due to like a lack of something, right? Yeah, well, so the close is kind of interesting, but you see the most volume at the open and the close. The close is quieter. It's a little bit more nuanced than that. There can be times where there actually ends up being more volume at the close. Generally speaking, the most volume is at the open, the second most is at the close. There's that period in between. It's like not even close. Like the amount of volume that you see at the open compared to like what you see at lunch is like not even close, right? It's like the open and close, you're talking about billions of orders. Yes. How did you get him to go back to sleep? He should be walking around. Where's Ethan? Okay. Yeah, leave the door open. I'm going to pause the music here for a second so that I can be sure to hear the baby if he... Oh, 3,700 into 04, huh? The 30-year really pushing through there, by the way. But again, I don't think that a time of day on its own is a good enough basis for a trade. Or rather, a time that is likely to be ranging is not a good base. Like a time that is likely to be trending could be a good thing. You could come in and say, I want to just trade the opening move in the S&P 500. And if you were able to find something that was gave you a good enough predictor of the order flow on the open, that could probably be a really useful strategy, right? But when you're looking for mean reversion, I think that you're looking for something a little bit different, because what you're looking for is like kind of the counter reaction after a large meta order has come through when the market is settling back into a spot, right? So yeah, I could see it at around the 10:15 to 10:45 period. That's probably the best point that you're going to get. Okay. But um you know, could not. Well, but you're saying you're looking for range, right? They're two different things, aren't they? They're two different things, aren't they? What I'm trying to say is I can predict mean reversion, I can't predict range. Because so I can predict mean reversion because we can see the liquidity holes form. Although it's hard to do it in equity indexes again. But we can see the liquidity holes form, and that tends to create mean. That's the force that creates mean reversion, right? But doesn't necessarily tell you range, because it could still like mean revert to one, still be biased to one side. It could be like a really teeny tiny range. It could be like a wide range that depends on how many orders there are out there and what the liquidity looks like, right? So I can predict mean reversion and not necessarily quote unquote range. Because range isn't like, again, it's like it's caused by a lack of something rather than something happening, right? So I can predict that a trend is going to happen because there's a piece of news or a predictor of order flow that's going to cause something to happen, right? The best I can do on trying to find a range is knowing that we don't have that going on. I suppose that Monday would be a good time because you don't have any economic news today, right? So it being a Monday would maybe be more beneficial to that. But it's kind of a very different thing saying, oh, I think we're going to see a trend because X thing happens, versus I think we're going to see range because there's no X thing to happen. Right? That's why, or again, the way that I would approach it is, ooh, that was another push through 04 there. Now let's see if they trade 03.5. Again, the way that I would think of it is there's three types of traders. There are noise traders, there are informed traders, and there's market makers, right? The noise traders, on the whole, lose money to the informed traders and the market makers. The informed trader, he knows something and knows that the market is likely to go in a certain direction. The market maker's advantage is the liquidity. Now, the market maker doesn't want to trade against the informed trader, right? So robots are really good at being the market maker. So probably the best space for us to fit into to make money is to be the informed trader, right? So if you're the informed trader, you know something is going to happen, or you have something that predicts order flow in a certain direction, then the informed trader is looking more for a trend, isn't it? So that's what I say. If you're going to be the informed trader, you're probably going to be looking more for the trend rather than the mean reversion. And the trick is just knowing when you actually have something and knowing when you don't, and not trading when you don't, which is most of the time. Good boy. You stay right here with me, puppy. Look, it's a puppy. Oh, say hello, puppy. Did Powell Did shake markets Friday, huh? What did he say? I was traveling. Oh, yes. So on Friday, Powell basically said that they expect interest rates. So a lot of it was what they've already said. They expect interest rates to be high for some time. But he also said that he anticipates some pain. So I think that his comments seemed very much geared towards scaring people. You know, like it was kind of like his comments were engineered to kind of freak the markets out a little bit. Okay, so what I'm seeing here in the markets is a little interesting. There is, on the whole, a lot more market sell volume than there is market buy volume in the end. Okay. There is some liquidity here down in the 04, 04 half, 03 half area. They were able to push through it, but it's just kind of ranging through there. So we may see trend continue through, but that's just kind of the situation right now. We're kind of being like, well, it is kind of to the downside, but there is liquidity there, so it might be difficult for it to continue just pushing. But I do think that the days, overall is towards higher rates. The advantage is towards higher rates. So there you go. There's, come on, touch 03. Nope. Mm-hmm. Do you watch Martin Shkreli lives? Not really. Martin Shkreli is an interesting guy. I keep track of what he's going, but I wouldn't consider myself like a fan. Like the thing is that I really just don't follow other influencers very closely. Maybe I should, but I don't really, like I should probably be like obsessive about who my competition is in the space. And like every time that I'm done trading, go and watch their whole stream and see which mistakes they made. But I just don't care. I just don't care about what other people are doing. One of the problems I'm having here. Maybe he's scaring people out so the market shorts, consumer confidence goes down, and he doesn't need to raise rates as much as he needs to. No, Kyle, I think I think I would say it a little bit differently than that. But I think that you're totally on the right track. I think that financial conditions overall have been very easy as of late because the market keeps trying to price in this supposed Fed pivot. And so the Fed is saying no. And that doesn't mean that they're not going to have to pivot if the market like takes a really bad turn south and we have a recession. It's just that at the current time, the Federal Reserve cannot afford to allow the market to price that in. They need the interest rates to stay high. So it is kind of like, yeah, we need to knock the markets down a notch, right? I think that's a major factor behind why he's talking. But I also think that the larger thing that he's saying is largely true, is that I would expect the Federal Reserve to raise rates here. I mean, if we don't have a recession, if we have a strong recession, and it looks like we're going to have a recession in Europe, although Goldman economists right now say that it's probably going to be a small one. Okay. But if we have a deep, very terrible recession here, then they're going to have to lower rates, right? But otherwise, I think that what you do is this is the level of economic activity that supply can sustain. And so you don't let off on the interest rates. You just keep them where they are. This is what I think ultimately happens. So him saying we expect rates to be high for some time, I think that that's prudent and accurate. And it continues to surprise me that markets don't believe that, but it could be some market liquidity demands and the SOFR futures and all that sort of thing could be at play there, right? So we'll see. Of course, once we get, I guess we do get non-farms this week, right? Is the first Friday. We get non-farms on Friday. Let me see here. Yep, non-farms on Friday. And then the CPI is going to be 2 weeks after that. So we won't get the CPI PPI until the 14th. And note that that is going to be within the Federal Reserve speaker blackout period again. So we're going to get a CPI and we're going to have to wait to see how the Fed speakers are responding to it by waiting until the meeting. Okay, so they busted through this liquidity at 04. Now it's kind of suggesting that 04 half is a liquidity hole because they're not really pushing further. They were for a moment, but that kind of sputtered out really quickly. And when did that start, by the way? At about 7:51. Interesting. It's still, a market's still not really giving me like a, oh yeah, there's really a strong market order short. You know, the volume is definitely sell, and I can see it in all three of these. And this move down was definitely stronger than any of the other volume that we've had during this session, even going back into the overnight. But it's still pretty tepid right now, right? It's even kind of saying like, hey, I could go back up to the highs if I wanted to. So it's a pretty slow Monday. Join us for a live event on Tuesday at 11 a.m. Eastern Time with New York Fed President John Williams to discuss the outlook for the economy, inflation, and interest rates. This is Nick Timmeros on Twitter. So the Wall Street Journal will have a live Q&A with New York Fed President John Williams. That will be an important event to watch tomorrow. Sure enough, there's the trend up. But let's see how far back they can go, because I'm betting that the liquidity is probably pretty light all the way through, maybe even up to 7.5. Didn't take very much volume for them to pull all the way back through that, did they? Okay. Well, the 30-year is still very, very much down there. So is this just this pullback steepening coming back through? Oh, we can turn the music back on again. I'll reset things so I can remember this spot. To tell you what, to the earlier question about range and everything, I mean, S&P 500 has been ranging a lot lately, hasn't it? S&P 500 has been ranging a lot lately. I guess I'm just saying, I think it's easier to predict the periods where it's going to trend than it is to predict the periods where it's going to range. And the range trade is kind of a fat-tailed event, so I think it's better to just go and look at the tails and just predict when the difficult to predict events are, because they actually are maybe a little bit easier to predict than we realize. Yeah, the 5 years definitely trying to get sucked back up there, so I definitely am seeing some steepening through this move. There's this Twitter account. Oh man, if you're a Republican and you're not following RNC research, you should totally, because that's a really entertaining account. Yeah, now we have a lo-fi hip-hop radio beats to relax. We can change it if you want. I'm using streambeats.com for the music, so if you guys want to select a different channel from that, we can change it. That last uptick, kind of the way that it happened, it made me think like, oh, maybe they're gonna keep going, but it slipped back down again. And it's definitely showing like the liquidity hole sort of thing in the 10-year, like as a zipper. Beats to relax / make it. Oh, you are making fun of another radio station's, like, I don't know what it is though. Who originally did that? See, I don't like this, like, strong order to the downside. Now just kind of like mean reversion. It retraces that whole move on nothing. That's not optimal. That was wrong. It's okay though. I felt like I reacted to my click there, but I think that was just a coincidence. Okay. So I just, well, I wouldn't call it a scratch. I took a small little loss there because even though we did get like a favorable move, really didn't give us very much, really didn't give us what we were expecting. And I'd been in that for a long time. I'd been in that for well over 90 minutes, right? How long was it? Time in? Yep, almost 90 minutes. So, you know, I gave it plenty of time to have a move, but it's just not coming through. And what was the most I ever got from it was like, what, 8 ticks? Okay, I got 8 ticks at one point, never even got 10. Now, if I had been a little bit more circumspect and had taken the 09.5 instead of the 10, maybe I could have taken a profit off of that, but treasuries look really tight this morning. There's a live streaming nonstop for years now. It's called Lo-Fi Hip Hop Radio, beats to relax / study too. Oh yeah. I have seen that thumbnail. I've definitely seen that. The whole lo-fi thing is really weird to me. Let's see here. Mohammed El Ran on Squawkbox CNBC. If he sticks to his script, we should expect a more hawkish talk as we go forward. But there are people that doubt that he will, says El Arian about Fed Chair Jay Powell. The fact that he stuck to the script made him come across as consistently hawkish. Do that, Mike. Having a little bit of trouble getting the words out there today. Today. Yeah, I just really don't like the way that come back. I mean, I don't think it's impossible that it flips back down and we get another further trend. It's just that I'm feeling like, yeah, here I am talking about like you want to catch a trend and you want to be informed and all these sorts of things, and here I am. I think that I'm informed and nothing's happened for 90 minutes. So am I really informed? No, probably not. So even though there's a possibility of another move coming, the market doesn't seem to be behaving the way that I want it to. The prudent thing for me to do is to take the small loss. So if it really flips down around lower aggressively, I think I'm gonna have to shrug my shoulders and be like, okay, oh well. Because so far, tight session. Every time that I see these pictures of COVID tests, I think that somebody's announcing that they're having a baby, and I get excited. I'm like, oh no, it's just they don't have COVID. Okay, nobody cares. At least I don't care. Okay, interesting. So CFVI, this is the SPAC that does Rumble. There were some people putting it on the radar, thinking that it would jump up because of Tate being banned and moving over to Rumble, but no. They started out at 10.4 and now they're at 10.21. So that kind of fizzled pretty hard. Not a lot of people in on that thing thinking that that's going to be buy. I think part of that is not a lot of people did the research to even find out that it's a thing. But then number two is I don't think that Tate's that widely followed, even though he was like getting, searched a lot and everything. That doesn't necessarily mean that there's lots of people that are like really enthusiastic about him and like him. Kind of more the controversy around him. So Taleb was talking about him last night, and there's just something that I've been thinking about a lot in relation to TikTok in general, that I really just don't, that really turns me off about TikTok. Like, I'm just a lot less interested in it than I was, because basically what happens is short form content optimizes towards having a really good hook, having something about your appearance, and sensationalism. So if you're like an influencer trying to educate people about trading, for instance, right? The only way that you're really going to get people to pay attention, I think, is like showing a really fancy car or something. Like, you can't come in and like actually teach them useful stuff, because not enough of them stick around that long, because there has to be something at the very beginning that catches their attention. And even if you have a really good hook, I think that you need more than just a good hook. You need to be like a pretty girl, or, have symbols of status, right? You have to have a bunch of stuff that says, oh, I'm a high status male. Look at me. Like Tate does. Why does Tate do so well? Because he is throwing the status in your face, right? Well, I feel like that would kind of not attract the audience that we want, wouldn't be beneficial to what we're actually trying to do, but it would be beneficial to what we're actually trying to do if we're trying to get more people right, in the long run. But then the whole problem is, what would you actually do to really bring that up, though? I don't really see it, because I'm not going to go and buy a Ferrari or anything. So I think that we should expect to see this bias in people going forward, that people pay attention to, you know, the sensationalism in the visual, because at the current time, the content on the internet is becoming more and more short form. Okay, so they did come back down there, down to 3.1 in the treasuries. I suppose I could get back in if I wanted to, but again, it's just kind of like oscillating. I kind of suspect that they'll come back down to like 0.5, 0.4 rather, and sit there. We got about 45 minutes. S&P 500 still looking good though. And gold's looking pretty good today too. So if I come back to a chart, volume profile chart, oh yeah, that is actually quite a significant pushback. Something I think I'd be kind of looking for is that if the economy does go south, I think the situation is such, because of the rates and everything, that we could see a really strong rally in gold. And if gold like takes off to new highs, like let's say that they get above 1825, for instance, that could really attract a lot of attention to gold. But you have to face it that your content is niche. I mean, you set triggers to attract the public, but they're essentially the folks who survived the first years of trading and are looking for better advice. Yeah, it is. I mean, I think that the bigger problem is that a lot of what we do here is excellence, right? And excellence is not what most people are looking for right now. And I don't know how you convince them. So I made a video, because people talking about quiet quitting. And so I made a pushback to the quiet quitting. Now, some people are saying that quiet quitting is just setting healthy boundaries for your job, but that's not what it is at all. Okay. Quiet quitting is literally like, add as little value as you can to your work, but just don't actually get fired. Okay. That's what quiet quitting does. And I told them, the problem with quiet quitting is that you want to be excellent. There are advantages to having excellence, and the only way that you can achieve excellence is by consistently putting that effort in every day. Because if you're just always holding back, then you never actually have it, right? If you're never giving 100%, your 100% doesn't actually exist, because you've never pushed that, right? You saw that video, that was great. Oh, I appreciate that, Kyle. So anyways, I make that video and everybody just wants to argue with me about it. It's just like, the comments on it like really surprised me. That there was like kind of this pushback. Like, people really just don't want to be excellent, I feel. Like, and part of the reason why I've kind of gotten on this tilt that like really the brand of our channel is integrity, excellence, and teamwork, right? Part of the reason that I'm on that is because I feel that those are the things that society is lacking or turning against now. Yeah. Giving your take on mainstream talk is a good start. I mean, how many people that are watching you now just met you from the GME live stream? I don't know. Like, I actually suspect, Kyle, that it's actually not that many. Like, that's the thing, is that when you get those people that are like come in for other things, that they don't stick around. That could change though. You know, where the content is going, we probably will start to get more traffic from people that are just more generally trading stocks. There's the other one that surprised me is that, you know, like I've made these videos about the Federal Reserve and interest rates and stuff, and they're just not gaining any traction at all. I don't know what I have to do. Maybe let's do a little research here. Well, distract ourselves while the S&P, you know, while the treasuries are about to push to where we wanted them to go originally. It's only 5 ticks, but like, look, that could be the possibility of it going further and turning into a strong trend. I don't know, there was a day the other week, like 2 weeks ago, where I held it almost the whole session, and then in the end I made $10, but like I was okay with that. That was fine. Okay, so I've got, let's see here. There's 2 videos here. There's the how to trade micro treasury yield futures. Analytics is what we want here. Okay, that's actually good. So this one, it started low. I won't show you the whole thing. I don't want to cover this up. It started out on the lower end, but it's picking up, and now it's gotten about 488 views. Where is the reach coming from, though? Okay, so the click-through rate is about average, 5%. Looks like it is coming from, okay, day trading futures, futures trading, bond yield, micro futures trading. Okay, so I think it is coming from search. Oh, and actually some of them are coming from the shorts. I probably should repost my stuff to YouTube more often. I feel like that too much of what I'm doing is like specific to TikTok, but I should be trying to make a small little. Did you get a cheap GPU yet? No, I'm waiting for the next generation of GPUs. Yeah, I'm not showing it on screen. You know, this is nothing that interesting to be worth putting it up and showing it to you, but looks like we are getting some from search. So that one actually turned out to be on par with what I wanted it to, but this latest one, how to trade the Federal Reserve. Wrong tab. This one is just trending well below its usual. So reach, the click-through rate is incredibly low. Well, I guess at times it gets up in there, but like it's just not, or not really getting a lot of, I don't know why that one doesn't do well. It's like something about the Federal Reserve turns people off. I thought that that was like such a brilliant thumbnail, but it's really not, apparently. So now, new private window. So if I come to YouTube and I say Federal Reserve explained meeting live, bank printing money, Bank of New York interest rates explained, trading Federal Reserve. No, see, that's like I've just kind of come across something that people don't actually search for, I guess. So I need to change the title on that. I don't know what I would change it to. What would we change it to? I wonder if there's maybe, I wonder if Devin Nash's community still kind of has spots where I can talk about that stuff. General. Maybe people search for Powell instead. would I see that? So if I search for Federal Reserve, no, it doesn't. I could use search analytics. I wanted to use YouTube specifically, but where are they at now? 105 still. It's looking like even if they go my way, that the most I'd be able to make off of that trade is $10. So I'm feeling a little bit like I want to still be in though. I always feel like that. I want to see, do I not, the YouTube buddy to not show up on the side unless I'm like signed in? Or did I turn it off? Yeah, if I'm in, then I get vidIQ. Oh no, wait. Hold on, let me try that again. Hey, there's a little bit better of a downtick there. Yeah, I guess YouTube buddy doesn't turn up in the private mode is what it was. A Fed, FOMC. Okay, well, let's just go to Google Trends. Federal Reserve, Jerome Powell. Jerome Powell is searched less. What if we just say Powell? That one says that just Powell is searched more. Maybe we should do Powell. He lost interest while they moved. There was the $10. Take it. I'll take it. The spot that I got out at wasn't a bad spot to get out. Sometimes the one I'll see will are like it went one way and that was like the worst spot to get out. That wasn't the case here. But man, what if it really drops here, right? It's really playing this, yeah, we're going to do exactly the move that you wanted, but we're not going to let you take advantage of it at all. And if I take 3.1, 3.11, they'll just come all the way back to 3.10. Yeah, I'm doing it on the micro yields. I lost $3. I've been doing really well on them, actually. That's because we keep getting these like big runners that are like worth $100. I was hoping maybe that's what we would get today, but did not play out in the way that I want to see a move, and so that's why we're not getting paid today. Am I too picky? Maybe I'm too picky. Because really the only reason I got out of that trade wasn't that I didn't believe it anymore. It was that it had just been in there for too long. Which is kind of... That's not a bad reason to get out, but it's not the best reason to get out, right? It does look like there's a large meta order, though. Like we're getting another leg here in the 10-year and the 30-year. Not a huge change in volume, so it's, I don't know, it's kind of difficult for me to say how far it's going to go. But look, we could have made 20 bucks. Ah, so pissed. Ugh. This isn't the fear of missing out. This is the realization of missing out is what this is. Oh, the Squawk just telling me that we have bill auctions in an hour. Interesting. And I love how it just moves on nothing. 6J going. I mean, it did almost exactly what I said I was afraid it would happen if I got out. So it did turn down and went to a new low. And there was a little bit more, the yields moved a little bit more on that move than they did on the initial ones. Because on the initial ones, like it got a pretty good move down and we hardly even made 10 bucks, right? Realization of missing a new term. Is that a new term? Oil is still pushing up, by the way. That might be a driver here. And the 6J is starting to push down. See, there is the part of the thing that really frustrates me too is that I know the conditions are as such that if I were to just buy in at, like, let's say 11.5, 3.115, the chances of that sitting back on me a little bit are actually pretty high. But at the same time, it's kind of given me this look like it's not going to stop. So you kind of have, it's not very good for trying to chase. In other words. Big possibility of disappointing yourself either way. I do kind of suspect though. Oh, and the Treasury's turn, or the S&P 500 turns down. Yeah, almost at the same time as when the Treasury started going lower. So the equity is not like that we're seeing higher rates. See, like they're gonna get 20. A little bit more volume there at 0.5 though. I don't know. So I'm seeing a possible liquidity hole at 0.5, but there's also 117 even below us, which is an area you'd think they want to get to. By the way, if you're one of the 700 people that bought into 117.08, you're probably really frustrated right now, aren't you? Let's reset. One of those upticks are a little bit more. Bossa Nova on the radio. What are you talking about? Oh yeah, this is called Jellyfish Bossa. I don't know what that is. What is that? That like a famous artist? It's a style of samba developed in the late 1950s and 1960s in Rio de Janeiro, Brazil, and it is characterized by a different beat that altered the harmonies with the introduction of unconventional chords and an innovative syncopation of traditional samba from a single rhythmic division. Okay. Oh, because because that's from your area of the world. Hence you reckon. I gotcha. I gotcha. Gold's turning around here, by the way. Oh, gold. Oil is up 3.26% now. Who's the biggest loser? Copper. Copper's the biggest loser still. DGC. Yeah, you're still trading gold, huh? Interesting. Ran into lots of open interest, huh? I mean, it kind of looks like it was a delayed reaction. Like the treasury started turning down lower a little bit before the oil started to shift per se. But they did follow in correlation. And there's 0.5 up again. So I think that does very much confirm a liquidity hole at 0.5. Now, it should always watch out for that move where it's like they make the liquidity hole and then there's a little bit further of a push and then it's done. Then it comes back. So you could be careful about that one. Is now the time where we would see a move like that, though? Now, probably the most likely scenario that we get is that it sits around for 45 minutes again. That if we do get another move, that it's going to be more like 11:15 Eastern time. But it's so hard to sit there and see the low of the day, low liquidity there, right? And not want to hit into that. I guess we could do it with the sim order. Oh, we have Brainerd speaking here? Oh, at 12:15. That's like a long time from now, dude. That's like an hour and a half from now. Ooh, look at that. That was an aggressive. That's the one, though. Hold on. Getting back to Powell, I think the ES move down Friday was just noise traders because the dollar is actually weakening since then. The Euro USD seems to have priced in the fear before everyone else. Well, so I think what's going on there is, so the interesting thing is that the most significant news produced on Friday actually came out of the ECB and not the Federal Reserve, right? I mean, yeah, what the Fed said was hawkish and it definitely had an impact on the equities market, but the yields didn't move nearly as much as I thought that they would have. And meanwhile, the ECB gave a significant piece of information saying that, you know, they're definitely getting more concerned about inflation and intend to act more forcefully. So I think that you should be seeing a little bit of euro strength here in this situation because of that. So that's kind of more this euro weakness reverting is what's causing that. So I wouldn't say that means that the move on the Friday was like, you know, didn't matter or anything like that. I think that the equity market priced in something that they should have been pricing in for a long time and weren't. So whether that's accurately priced in or not is a different question. So I forget, did I get in at 10? 099 would have been 20. What was that? I got in at 0.10, now it's 0.12. So dollar weakening is just euro weights on the index. Actually, euro is going up. That could be. But like the thing is that it hasn't really moved a whole lot. Here's the thing: is we still going to have the end of the month rebalancing stuff behavior going on this week, right? Something that I think we might see, this behavior that we've seen here in the treasuries, I think we're probably going to see a lot of that this week. Catalyst that will bring this entire market down and send us into a depression will be the housing glow. Well, I don't know about that one, to be honest with you, Jimmy. Which happens to be the reason how Powell can't hike with big moves. He's trying to walk the market down. I don't think so. So something that's happening right now is that all of these builders really tried to build a lot, and then the prices came down. So like there's all of this inventory coming out onto the market. Yeah. But I don't see that having knockoff effects into the broader economy, to be honest with you. And in the end, demand for housing is still going to be high. So it could come back very forcefully. I really don't think that that's going to be the thing that like really causes things to fall. You know, that's one that like, if there's a housing market crash, there's going to be a whole bunch of other crazy stuff that happens first. You know what I mean? I think that instead, we're already seeing it. Essentially, people are living in a fantasy world. No, they're not. Like really, there are not enough houses for the number of people that want to have them. Right? The lack of demand that you're seeing right now is a temporary thing. So, but I think that this energy crisis that you're getting in Europe is a problem. Now, economists are saying that it's only going to be a mild recession in Europe, but pretty sure we're going to see a recession in Europe. I don't know what that means for the US per se, but really at the bigger look, oh man, that trade that I did there on the treasury worked so freaking well. How many? I've done that now 2 or 3 times in a row. That seems like a really reliable technical trade. I need to continue to stay on that one. There's plenty of housing. Well, but Jimmy, here's the thing that you guys aren't considering. Okay, there's here. I've been in this house that I live in for like 5 years now, over 5 years. So I've been in my house for a while. Okay, I am 37 years old. Okay, so there are all of these millennials behind me. Okay, I'm one of the lucky people. Okay, I worked for a big bank for a while. I saved up as much money as I could. Every time that they gave me a bonus, I was saving it up so that I could put it in a house. And then when I got remarried, we like totally refurbished her house and resold it when the market was just starting to get a little bit hot. Before things kind of fell apart in December of 2018. So we made a ton off of her house, and that's how I was able to put so much equity in this house and have a nice house, right? Nobody else my age has this. Like nobody else my age. And guess what? Millennials are the largest generation. They may be the largest generation ever. Yes, there are more millennials than there are baby boomers now. There are more millennials than there are baby boomers. It's just that like the percentage increase from millennials to Gen X is smaller than the generational increase from the greatest generation to baby boomers, right? But like the actual number of people, there's more millennials, right? They want houses. Like this whole thing that happened during the pandemic, it didn't happen just for no reason, okay? Housing would have been really hot even if they hadn't have pushed interest rates down to practically nothing, right? So yeah, the rate increases like really destroyed really destroyed the demand, because like freaking seriously, who can afford to spend $1 million on a house? That's a problem. Okay. But those people out there that want to buy a house, the millennials that are in the point of their life where they don't want to rent anymore, that's not going away. It's not going away. And it's not a bubble. There is a real demand for it. You've just pushed price outside of that demand. Now there's a bubble in China, that's for sure. There's a bubble in China. Listen, these doomsday scenarios, they almost never happen. If people can't pay their electric bills, but they're going to buy your house, no, it's not biased. Again, listen to what I'm saying. Demand for housing is not going away, even if in the short term people can't afford it. What does that mean? That means that if there is a quote unquote housing bubble, I'm going to buy as much of that fucking stuff as I can. Because they're still going to want to buy houses. Of course, right now, you're still not really to a point where you can really buy things, are you? You want to buy stuff to rent? If we go into a recession, it could certainly be worse, right? But like there's the other problem, is that you're looking for like the last crisis, right? Like there's already done a lot of things. If things really got dire in the housing market, they can go and they can buy housing securities. They can go, like if you're expecting to be you know, the Great Short Part 2, you're probably going to be disappointed. Oh, now, okay, now there could be a situation for sure where all of the sudden the cost of making houses declines significantly. Yeah, that could happen. Either because people take mini houses, although I know, like, so here's the thing, like the cost of housing is really high, but you have to realize that like the medium home is much larger now than what the medium home was like 50 years ago. So that's another thing that's kind of going on that you got to think about. But there could be, you know, where automation makes the cost of building a new house come down considerably. I mean, because there's definitely some things about building materials causing the cost of housing. Like, this is the thing, is like all of these guys, they built their houses when the input costs were the highest. So I'm sure there's going to be a lot of developers that are just going to they're going to be very unhappy, let's say, right? My friend just borrowed money at 2% and rates moved to 10. Well, we're not even close to 10% yet though, right? I think that right now, a 30-year mortgage is like 5%. Like, this is the crazy thing, guys, is that like a 5% mortgage is like pretty close to like the historical average, right? You're saying that the market is going to collapse because 5% interest rates are too high? Ooh, okay. Wait until they're 8, 10. Okay, maybe 10. 10 would be, they might not get to that. I think that if we were going down that path, that we would fall into recession before we hit 10. Personally. Okay, inflation in the USA is more like 18% when rates get to 10. Okay, so I think what you're saying is that in the 80s, they changed the way that they measured the CPI. And there's a lot of people that say, well, if you use the old version of the CPI, then inflation is much higher. That's correct, except for that you're making an assumption that the older CPI was a better, more accurate way of measuring it, which it really wasn't. There's a very good reason why they changed that. The historical average is 12%? Okay, wow. Cooking the books. Oh, man. I'm sorry, man, but all I can do is laugh when I see comments like that, because I've basically sat and watched people say the sort of thing that you're saying right now for 14 years. They always come around every year for 14 years. Every time there's another housing bubble is going to come because houses are too expensive, or, you know, we're going to have a debt crisis, this sort of thing. It never happens. If real estate, probably not. Probably not. But I think the bigger thing that I'm trying to say here is not that housing prices won't go lower. It's that real estate's probably not the thing that I would be concerned about right now. Right? And that a strong decline in the housing market would not necessarily be the sort of like system breaking event like it was before. Dump 40%. Well, I'd have to look at the prices of mediums homes to where they're going. I don't think that you're gonna really get, so let's come here. Should we do median home price? How about that? And St. Louis Fed has a chart on that. Let's look at that one. Cool. Okay. So, if we were to decline, it says that right now, quarter 2, 2022, it's probably already come down a lot, but right now it's 440. Okay. Calculator, come on. Okay, so if we say 440,000 times 0.6, you're saying that the median home price is going to go to 264, which would put us just a tad above the peak from 2005. I'm going to say that's probably about the lowest I could see it going. It's probably unlikely to go back that far. I think, though, that you could retrace all of this stuff. Like, it could go back to 300. Let's say 300. I think that 300 is a fair estimate for where medium home price could go back to. U.S. households have less money now than they had at the lows of debt. Well, okay, but housing never crashed. Well, it can certainly decline a lot, can't it? It can certainly decline a lot more than people expect it to. But again, so let's just go with my estimate, just because it's a little bit more tepid of a case. Okay. Well, no. Rather, we should go with your estimate. Okay. If we had a 40% decline in home prices, okay, it wouldn't be in the end of the economy. It'd be pretty ugly. But housing wouldn't be the thing causing the problem, right? What would be the thing causing the problem? Inflation, food prices, energy prices, high interest rates. So is housing really the place to be looking to be saying here's where it's going to go? Probably not. We have the greatest army so we can do more debt. I think that when the US debt gets above $40 trillion, that's when we will start to have political problems about it. Right now, we're at like 28, right? After all is said and done. And we could be going into recession, that's for sure. Question about how deep would it be. Like, here's the thing that's really curious. So here's what we really should be looking at. So like here's again, if you're gonna day trade, for you guys that are here every day, right? What's the biggest thing that's gonna help you, right? Well, there's a pretty big data release this Friday, right? Average hourly earnings month over month, they're expecting spot 4 versus a previous reading of spot 5. That's possible, although we did get some numbers last week that kind of suggest that might be more like 0.5. Okay, non-farm employment change, they're expecting 295k versus 528k. Well, that's a really big change, isn't it? So that 528, oh, now that's interesting. Okay, so the expectation continues. This expectation actually isn't too different from what was expected last time around. So for some reason, the expectation doesn't change, even though the last 3 months they've outperformed it easily. Right? So that's a problem, right? Because what's most likely to happen is maybe they come out at 250. That's good. Average hourly earnings spot 4, maybe spot 5. Spot 4 would be really bad. Unemployment rate matters too. Remember that the unemployment rate is a separate survey. Unemployment rate continues to be, well, 3.5, but it is ticking up a little bit. Ooh, maybe 3.6, 3.7, right? That's going to push the rates up. That would push rates up. And then you have a problem, right? Or what happens with food and energy? Well, you're not going to see those ones until October, right? Worrying about housing, I don't see how that helps you in the short term here. It kind of sounds like a really another good example here. Here's what I think this is most comparable to, was people saying that we're going to have a famine. Remember people saying that like back in March? Who was it? Meet Kevin. That's right. Meet Kevin. He got out of the market back in February, March, because he said that there was going to be a famine. Well, that actually ended up being a good place to get out, but we didn't, not for the reasons that he thought that they were going to be, were they? Right? It's like, well, we did go down, but there wasn't the famine. We might still have the famine or whatever, we might have some increased food prices that cause a lot of chaos, but it was just like too early, right? And wasn't the thing that really mattered, wasn't the thing that really drove it, right? And that's what I'm trying to say to you. Is like what's going to push us into a recession? It's going to be energy costs in Europe and higher interest rates in the United States. I mean, assuming that you don't already believe that we're already in a recession. But let's just say that maybe we're in a recession, but we're not in like a really traditional one yet. Okay. So if we get back into a traditional recession, and it could be the case that we're just destined, like it's going to happen and we just haven't figured it out yet, right? If we go into a more traditional recession, what's going to be the catalysts that push the market down? It's not going to be real estate. I'm sorry. It's not. If anything, the markets might be like, oh yeah, lower real estate prices. That's good. because nobody can afford a home with when you have the high price and the interest rate. So something kind of has to give. If you do any Series 7, well, hold on a second. I don't know if I believe you. I gotta go though. Well, okay. I'm gonna start. Hold on a second. I got enough that I do need to. Oh man. All right, so here we're going to read our Securities Training Corporation. Do they have an index at the back? No, they don't. Oh, there's so many chapters. That's Series 7. I'm doing the 65. They don't say what a recession is. Securities, customer accounts, equities, fundamentals of debt, corporate bonds, municipal securities, Securities Act, exemption, exempt, over the counter, exchange markets. I really don't think that that's something that's going to be in here. Current accounts, other positions. Option markets, retirement accounts, packaging product annuities, direct participation programs, economics and securities analysis, economics, GMP, inflation and deflation, business cycle. Okay, maybe chapter 22. Okay, so maybe at the very, very end here. Maybe at the very, very end here. That's a big book. Come on. There we go. Oh, those are tests. Oh, here we go. Wait, here I found definitions here at the end. Okay. All right, just say, well, it doesn't say per se, but a phase of the business cycle characterized by reduced business activity, reduced corporate and personal borrowing, and rising unemployment. Generally defined as 2 consecutive quarters of decline in GDP. Generally defined. Well, here's the problem, though, is that the people that like officially label recessions, like when they say a quarter starts and ends, is different from like the GDP numbers that we look at, right? And so from where they look at it, it hasn't even hit that technical point. So I think we could say that we were in there. Like I said, I think that it could be the case that we're in a recession and it's just not going to reflect in unemployment yet. And that, you know, here in a couple of months, we'll see it come through eventually. But for now, there's been a lot of people, I have seen a lot of people in the last month saying, oh, recession, sell all the things, and it coming back in their face, right? Anyways, we should continue this tomorrow, but I got to get going. So I'll see you guys tomorrow. In the meantime, stay excellent.